I'll be doing the presentation, or who is going to, somebody's going to take my screen, or how are we going to do? Rashmi?
Sure, Vijay, I'll share the PPT.
Gaurav, the haircut of Chhai is very good. Excellent. I'm impressed.
Gaurav is giving you a hint.
Yeah.
Okay.
I get the same one for my next appointment.
Now I said, let's talk. I think we had a discussion, Gaurav, Vijay, and we had a discussion about, and me and Pooja were discussed about what is happening with the interest rate environment. We go for future, we interested in the fundamental of the economy. But just let's maybe start the discussion. I'll just give you a brief presentation about a couple of slides on to what is an interest rate and how the things work into the real life world. But before I go into that, Max, the whole surge in global commodity prices and then the fluctuating. I think I was with Chhai last week, 2 months back, and we were discussing about the iron ore price, and we were both betting around or working around to go at 230. Chhai, you're wrong. You remember?
So what was the comment? Was it a comment around IMF funding?
Yes, we were talking about iron ore, and we
iron ore.
Yes.
Yeah, look, iron ore has been. We put out a paper recently on iron ore. It's driven by, as you know, steel demand out of China, and you can't predict or forecast Chinese government policy. Effectively, that's what it is. No one can. So that's driving the iron ore price. But we do know that the demographic shift from the rural parts of China to more central city-based Chinese economies, it does require continuous build-up of infrastructure, which requires steel, which requires iron ore. And in fact, I was reading an article, I'll end on this, about just recently the demand for infrastructure that will go into building, green power generating sources. So whether it's, hydro plants, whether it's wind turbine plants, whether it's solar panel plants or whatever it is, all of that infrastructure for green energy production is going to need steel, which is going to have iron ore behind it. So longer term trend is in favor, but in between, I think is going to be volatile. And
That's fine. I think
I would absolutely agree with.
I think we will talk more into exactly what is the interest rate and how are we going. I think next, please.
Yeah.
So why interest rate matters now? Basically, now in last two years, like basically coronavirus and whole thing, and the Delta virus had affected the whole economy across the world, and the central banks put a lot of money into the system, and like coming back in last 1 year and now another 2 or 3 months, all the economies are hoping to be opening up, and now the system is a little bit more stronger, and overall the world will start moving after a while. In Australia as well, like we are hoping around October 15 or somewhere, the economy should be opening. But what has happened in last 1.5 years? Let's see a couple of signals across the board. So next slide, please. Yeah, so now we're talking about inflation. So when we talk about inflation, then Reserve Bank of Australia has a target inflation of keeping around 2 to 3%. And inflation and interest rate is the basic fundamental of the economy. So looking forward, like last year, as the economy slowed down, if you see around 2020, the inflation went in around on the most bottom to around 0%. That is around March or April somewhere last year. And now again, if you look at the highest level, it is around coming around 5.8% in the last June quarter. That was the whole thing. Now, what happens when the inflation CPI index increases? Then the overall commodity, I mean, why this has happened? So we look around that the basics, the commodity prices increase across the board. So the first is basically, if we talk about the crude oil prices, that's highest again, 83. We talked about just recently, we talked about iron ore that is spiking as well. And what do you see there and what is happening in that? And if interested, are the interested going to increase? What is the scenario? If interest rate increasing, then the whole mortgage market, the commercial borrowing, that will change the whole scenario of the interest, I mean, the borrowing market. So let's consider where are we into this inflation. So now, is this inflation a temporary spike or it is a couple of months more phenomena? We go more into detail about that. Next, please. Okay, so now we're looking at the global market across what's happening into the US economy and where is the interest rate in over there and what is the demand and supply. So first thing is very clear now that at least the economy has started moving and this whole cycle is moving on. So the American economy, when we talked about the US economy is around, can I go the first slide before? I'm so sorry, Rashmi. Yep, sorry. So look sorry. Rashmi, okay? Yep. Okay, let's keep this one. Thank you. So number of this is we are in a slide. So we talked about 5 point around that inflation. Okay. So now we're coming back to the inflation in US. What is happening in US? So slide number 4. That's what we are in. Okay. So in US, going to the US as well. Look, it's in the February 2000 last year or March when the corona was there. The inflation was around 2.6 or around that ballpark figure. And again in the last quarter and June, and now it's approximately almost double to 5.3%. So that boosts up the overall the cost across the board into the industry. So that will the cost of borrowing for the residential side, the cost of borrowing onto the commercial side will increase as well. There is a possibility if provided the central banks across the board start increasing. So the 5.3% is it's a little critical point into the US. Where are we going from now over here? Next slide, please. So let's look around what's happening into the European markets. So in the European as well, so around same when the corona started, around the inflation came to the negative 0.3% and the 0% around that ballpark figure. And then now last, so it's not that bad as compared to what is in the US. So Europe is basically reasonable into that ballpark figure. So they are very comfortable, but still there is a lot of pressure that, okay, we have to be monitoring. So a lot of central banks are saying this way that this is a temporary phenomena. So that can increase, go to 1 or 2 quarters, and then it can be, it will slow down. That is the overall, the Europeans are saying that, the European Central Bank are saying that way. Next, please. So if you look at the global overall, all the parts of the world, where are we and what is the forecast of the inflation across the board? So in the US, again, say, look, they are looking at 5.3% at least as we talk, but the forecast is coming down. So that's a good signal. Same as in Europe, the forecast of the banks are coming to around 1.9%. Australia, we are the last quarter we saw around 3.8%. That's coming down as well. And in India as well, it's a 5.3 and going to 5.4%. China as well. Now the Chinese side, the 0.4 to 4.3%, that's what they are forecasting. So again, the whole demand of the commodity prices that can increase the overall phenomena, and the whole cost of borrowings and those things will increase. So let's, but overall the world economy, all the central banks are thinking that it is a temporary spike into the inflation, but still that more information and more quarterly industrial production things and those things that banks are monitoring, that where are we going from here. Let's hope that it's the forecast of what we are talking about remains on a similar basis. Next, please. So what is this driving inflation as we talked about? So basically for in any markets, the market consists of the customers, the retailers, the wholesalers, the distributors, and factories. So factories are basically the industrial production services or the services production industry. So we talk about the industry. The retail customers and the residential customers across those. So basically, this is the whole supply chain. So that supply chain, when the cost of productions are increased, the overall cost increases across that's how the sign is. So there is a huge demand that came in with a lot of money flowing, and the economy is literally onto the lower level, and then it has increased. So it's a supply, it's the whole effect across the board. So that's why we can see the spike into the inflation. Next, please. So going forward to this one, what will be the effect onto the bond, 10-year bond yield? Pooja, you want to talk about the bond yield a little bit?
Yeah, sure. Thank you, Vijay.
Yeah. So basically, yes, the risk is you can see the 10-year bond yield, but yes, Pooja. So basically, I think as the bond prices are inversely proportional to the interest rate. So if the interest rate goes in, the bond prices goes down, and the yield works on simultaneous. Pooja, what's your opinion?
Yeah. Yes, so well, we have now seen from the charts so far that inflation has been running up for months, but it didn't drive up bond yields or interest rates in the markets until in the past couple of weeks. Also, when bond yields jumped from 1.3% to over 1.5, that is a cause for concern, as it means, losses for bondholders and equities coming under pressure. So yeah, but in recent weeks, that narrative has changed to inflationary supply chain issues that may persist for the next few months before coming back down eventually.
Yes, exactly. So that is a spike. I think that's again declining, but let's see how that comes in. So, but I think only the Norway has increased the interest rate. So let's see how the other central banks are coming, and that will deeply impact the yield as well. Next, please. Yeah, Pooja. So as I said, look at the same thing. The bond sensitivity of the bond price in the fixed interest market. So as there is an increase in the interest rate effect, or straight away the bond prices decline straight away. It's a sensitivity. It's called sensitivity index as well. Pooja.
Yep. So if we look at the red line chart, which is the 10-year bond price versus the bond yield rate, as we can see, if the bond rate say so from 1% to 4%, then the 10-year bond price would fall from $150 to $120, which is a decline of 14% in value of that investment. Yes. Next. Yep. So yeah, we can see the change in US bond yield curve. For the US government bonds, this chart illustrates the parts of the yield curve that are seeing a lift in interest rates. We can see that borrowing rates in the 2-year to 30-year bonds have risen slowly over the past 1 month. If these rates persist at these levels, then we could start to see higher interest rates transmit to retail loans and corporate borrowing costs. Yep, next slide. So this is a chart where we can see the change in euro bond yield curve. This is the same story in euro area where bond yields, have started to rise. Yep. Can we have the next slide? So markets worried by the first rate rise in euro. And this is another reason why bond yields have risen and equity markets are coming under pressure as investors respond with fear to the potential start to the rate tightening cycle across the developed countries. Norway's central bank is the first of G10 central banks that has raised its rates from 0 to 0.25%, with the bank indicating more rises in 2022. So, yeah. What is what is your view on inflation and interest rates over the coming months?
Yes, question that I was looking as well. That Minson Kim is asking that question. What's your viewpoint onto the interest rate? So as we talked about that, this is a temporary phenomena. It looks that way. That's what the central bank is saying. And look, in any scenarios, there are fad, fashion, and trend. So basically, in the trend scenarios, considering the demographic scenarios and those things, we fairly feel this way that that there will be the long-term interest rate market will be same on the lower side. That's that's what we're looking around. So there will be a little bit spike as temporary phenomena, but let's see. I mean, we are hoping strongly onto that. Yes, Pooja.
Yeah.
And before, yep.
Yeah.
Before we go, I think we were talking about two stocks onto that line, and we had a talk with Gaurav. And Gaurav, what do you think about that? One of the two stocks which we are betting, I think you feel very good to be holding on. I think we're talking points back holding.
Yeah. So thank you, Vijay. So one of the key stocks that we've been holding in our.
Can you change the slide, please? Next, please.
Yeah. Thank you. So one of the key stocks that we've been holding in our small cap strategy is PointsBet Holding. So PointsBet Holding is a corporate bookmaker operating in Australia and the US at the moment. Currently in about 5 states in the US, and it offers sports and racing betting products through its cloud-based wagering platform. And it also offers iGaming in Michigan and New Jersey. So the company has developed a scalable cloud-based wagering platform, and its key products include fixed odds sports, fixed odds racing, and points betting.
Next
slide, please.
Yep.
So why we hold this stock? The US growth opportunity presents a big opportunity for the company. So since in 2018, the Supreme Court of the US legalized sports betting in the country. It allowed states to go forward and legalize sports betting. And since change of that landscape, it is estimated that the US market would grow to about $51 billion by 2033, which and PointsBet Holding is supposed to be a beneficiary of a more open wagering market. Second point, its proprietary technology stack. The company has developed its own proprietary technology, which is developed in-house and is not using something like a third, like something from an external provider. So what it provides the company with is more control and the ability to roll out its updates without going to an external provider. And recently, the company has done some strategic acquisitions, which is strengthening the tech advantage. The company has completed 2 acquisitions, Banash Technology from Ireland and Premier Turf Club in the US, both of which are expected to enhance PointsBet's proprietary in-house technology. So Banash positions PointsBet to be a market leader in the in-play sports betting market, which is currently about 75% of the European market, and a level which management believes that the US market can get to over time as it develops. Second, a big point. So NFL, as you know, NFL is a big sports opportunity in the US, and NFL, the company has become one of the 4 additional tier 2 partners. So recently, three partners signed an inaugural $1 billion partnership with the NFL: Caesars Entertainment, DraftKings, and MGM Resorts. And PointsBet is one of the additional tier 2 partners, including FanDuel, FoxBet, and WinBet. Now, according to American Gaming Association, an estimated 45.2 million Americans plan to wager on the 2021 NFL season, which is up 36% year over year. And the sports betting is estimated to be about $12 billion for this year alone. And becoming an NFL sportsbook operator will allow PointsBet the ability to bid for integrations across the NFL network. So the company has a growing market. It's recently launched into West Virginia and will continue with 11 more states plus Canadian market by December 2022.
Okay. So Gaurav, basically you're talking about this whole about PointsBet, it basically the global expansion, that's all the key driving force.
Sorry, I didn't get your question.
I mean to say for PointsBet, the whole viewpoint is the global expansion. I mean,
the whole point is the globe. So the company has a big market share in Australia at the moment, but they are expanding into the US. And as more states legalize, they are acquiring more state licenses, which for the time being is supposed to be a drag on the US margins because of the acquisition costs. But as the company gains scale, the margins will revert back to the Australian margins. Like for this year, FY21, the Australian gross profit margins were fairly consistent, and management expects as the company grows its scale in the US for the US margins to be in line as well.
Fantastic, Gaurav. I think we will monitor these things and get back to you. And what do you, I mean, it's a around $12 on some here, and I think approximately 20% plus minus should be there in coming times. It looks that way.
Yeah.
Yeah, but I think, but everything depends on the growth and I think
everything
the regulations
depends on the
well.
growth. The near term expenses could be a little bit higher because of the acquisition costs. But the growth opportunity in the US and Canada represents a big opportunity for the company.
Fantastic. Gaurav, that was fantastic. We agree with that. Pooja, your opinion, what do you say?
Yes, I agree with what Gaurav has just said. Fantastic.
Max? Max is betting too much, I know him. So let's hope.
I'm not a big betting man, but yeah, I mean the company's got strong legs, and we like to see obviously companies that have delivered on growth in their home market and taking something special overseas. So yeah, we've got good tailwinds, I think.
Yeah, it's a growth company. No, very good. Thank you, Gaurav. I think you were talking about the other one onto the shopping front, because they're in online shopping and those things. So you next slide, please. And that is basically, let's talk about Temple and Webster Group. Gaurav, to you. What's your opinion?
Yeah, thank you, Vijay. So Temple and Webster Group is an online shopping company with its exposure to it's basically shopping for furniture. So the homeware, home decor, arts, gifts, lifestyle products, and it's a pure online play. It's a leading online retailer with strong growth in customer numbers in past few years, which has so the COVID-19 pandemic has basically been a tailwind for the company as the stores closed down and people were unable to go out to shop for furniture, but still the discretionary spending went up in Australia, which saw the companies we saw a lot of consumers going to this company, Temple and Webster, to shop online for their home needs, which could be seen from their share price rally as well, which has delivered about more than 1100% from since beginning. Can I get the next slide, please? Yes. So the company operates in a very large addressable market. So business to consumer furniture market is considered to be approximately $16 billion. What is interesting to see is that the company has as a huge growth opportunity, because the Australian market in B2C furniture online is still about is less than about is still very much below the US, where the penetration rate is about 25% versus Australia, where it's about 10%, which presents a huge growth opportunity for the company. So the company has seen revenue per customer grow. The revenue this year alone grew 12% year over year, driven by higher repeat rate and average order value. So the company has seen its strong growth in revenue, even after its results from 1st July to 24th July, about 39% growth. And the company said that it's experiencing tailwinds, including adoption of online shopping due to structural demographic shifts and due to COVID. And as you all know, the housing market in Australia is pretty hot at the moment, and it's continued its recovery, which is another tailwind for the company. Stores closed down because of the lockdowns, but housing market continues to flourish. Where do consumers go? They go online and shop all their furniture from Temple & Webster. So the company has a very strong balance sheet, which gives it an opportunity to take advantage of M&A opportunities. And the company is using its technology to improve the customer experience. It's investing in its warehouses and using AR, and which also saw the company's net promoter score revert back to 65% from lows in 2020 to about 65% in 2021 this year.
Fantastic, Gaurav. Now, Gaurav, just further looking at this, what do you think? Why this Temple & Webster is growing so rapidly?
I mean, it's
what is the advantage? What is the strategic advantage the company is having?
Gaurav, I can add to that as well. Sorry, Gaurav. The critical advantage really is that Temple & Webster is disrupting the furniture part of the consumer market now. So we've seen smaller item consumer products move on to e-commerce and online, but people are still sort of going into your Harvey Normans and whatnot to buy their everyday household furniture. And people are slowly starting to realize that this can be done online. So that part of the market in Australia, the online penetration is still very low. And for every dollar that is, from the last data point that we had, every dollar that's being transferred in that segment of consumer products, Temple & Webster is picking up 20 to 30 cents. So that's why it's growing so fast. So key points really is it's a market that still hasn't seen online penetration. If you look at US comparable, it's much higher in the same segment. And a lot of people don't understand that Temple & Webster is not selling your big 20, 30,000 lounges or dining tables. You know, these are everyday household items around your lounge room, which you simply can buy online, provided that a client can have a really good online user experience. Means Pooja, Vijay can go on and see the side table in different settings with different lounges and whatnot. And that's what Temple & Webster really offers. So they're looking to grow 20, 30% per annum to stay ahead and become the #1 marketplace in Australia.
Fantastic. No, good to know. I think that is classic. Really good. Nice one.
It's Chhai here. I think what I would add when I met with the company was the critical, we're at a critical inflection point for this company in the sense that the economy, the Australian economy is starting to open up again, especially in New South Wales, obviously not Victoria, but we're coming out of lockdown. And the critical question is, has the company done enough to, and I guess, has the online economy done enough to structurally change consumer buying patterns? If the answer is that no, consumers are going back to buying vast bricks and mortars, then it's a big risk for this company. But if the answer is yes, we're structurally have changed now in terms of how we purchase household items, then it's to the benefit of this company, as what Gaurav was saying and as what Zach was saying.
Yep.
Sorry,
Fantastic.
off
Yep.
there. Over to you.
Very good. Anybody, I mean, people can ask questions. Anybody wants to go forward, please? Vincent, you were asking something. No, we can't hear you. Mic is off.
So I think Minson has a question in the chat. He's asking, isn't it good for investors to buy cheap bond and yield goes up?
Yes, Chhai. Yes, Chhai.
Yeah.
You can answer. You are a better onto that.
I can take that if you want, guys.
Please.
Yeah. So look, it's all about a relative call with bond yield. So if there's different kind of bond structures, there's floating rate notes, which aren't as much exposed to rising yields. But if we use Minson's example and we take a fixed coupon bond, so that tends to be your sovereign bonds, and which tend to dictate where the bond yields are tracking in the broader global markets. So in a fixed coupon bond rate, it's all about where we are in the cycle of rising yields or declining yields. So obviously, if we're in a rising yield environment, which is currently what the narrative suggests, then these fixed coupon bonds will obviously have a capital loss because the price of these bonds will have to adjust to account for higher yields, because clients, investors will say we can get much cheaper yields elsewhere or higher yields, then the overall bond value has to adjust. So it's all about where your expectation of broader market yields are going. It's not like a stock where if the price drops and the dividend starts to become more attractive and you get a higher yield, it's not the same. It's not the same kind of structure or the same sort of dynamics.
No, Zach, thank you very much. That was fantastic. I think we make it very, very clear, Zach. Thank you very much. Vincent, that answers the question. We got Shruti is asking, oil price have rallied recently. How are we positioned?
Chhai, do you want to take that?
I can certainly take this one because we wrote on Monday to quite a lot of investors in our portfolios. We're positioned very favorably. So we've got positions in the domestic portfolio in terms of Oil Search, Santos, Woodside Petroleum, and also obviously our position via BHP gives us some exposure there. We've spoken in the past about the merger between Woodside and BHP right now, as well as Oil Search and Santos. So things are obviously evolving there. We've been exposed to, our portfolios have been waiting for this rally for the better part of a good 10 months now. We saw that, oil prices, for good reason, were severely impacted by the lockdowns occurring globally, and obviously as a result of the response by various countries to the COVID pandemic. So we've been playing this rally for quite some, or waiting for this rally for quite some time, and even before the rally, the various companies that were positioned in already saw substantial rally off the advent of the pandemic back in March 2020. So, we're beneficiaries to that. The question now for us that we're monitoring is some of the developments with OPEC meeting on Monday, them, getting some pressure from the US and the US particularly, and India, who are having an effect on, in terms of I wouldn't say mismanagement, but for lack of better wording, mismanagement of their energy situation, which we're seeing around the world, in Europe, in India, in China even, and we're beneficiaries to that at the moment in the portfolios. Hopefully that answers the question, Shruti.
Yep. Thank you, Chai. Thank you all. I think that was brilliant. Max, thank you very much. Thank you all of the viewers and everybody. That was very good, brilliant. Thank you, Max. Thank you, Chai. Thank you, Gaurav. Thank you, Zach. Thank you, Pooja. Thank you. See you next week, same time, Wednesday, 12 o'clock. I'll see you then. Thank you, guys. Beautiful.
Thank you.
Thank you, Chai.
Bye.
Bye-bye.